And joining us now, personal finance expert Dan Roccato. Dan, good morning to you.
What's up, Bill? How you feeling?
Great. So let's start with interest rates. Don't feel so great about that. So how does this affect us really in our everyday life, and how high do we expect these rates to go? The Fed just keeps hiking it up.
Yeah, the price of money, and that's what interest rates are, Bill. The price of money keeps going up. Fed has boosted I think 8 times so far in the last year or so, and more to come, as you said. More, we'll get another one in a couple of weeks, and I suspect another one after that at least. Bottom line is this. Consumers kind of have this situation where if you have debt, especially debt that can change, like credit card debt, where the interest rate changes often, you're not in a good position because that means you're paying more for that credit, especially those credit cards. And that's not a good thing for a lot of consumers who carry a balance on their credit cards, especially if you're looking to buy a house, get a car loan. Those loans are also going to get more expensive as well. So all in all, the price of money goes up. You and I pay more for it.
And we saw a lot of news reports yesterday. So what is the producer price index? How does that affect inflation?
Yeah, here's the thing, right? We were sitting back, we're eating our mini wheats this morning here in Seattle. Where, we hear terms like that, like our eyes glaze over. Here's the bottom line. Your Slurpee is more expensive today than it was last month, right? So the bottom line is inflation right now running about 6.4%. Inflation in this country is still too high. The Fed wants it down to 2%. So we still have a long way to go. And consumers, we may not know all the economic terms, but we sure know when we're paying more for things at the grocery store.
Well, folks are working right now. Unemployment claims remain historically low, but that is not necessarily a good thing for inflation. So can you explain that?
I'm glad you said that. This is the irony of the situation where sometimes, bad news is good news is bad news on Wall Street. The job market is still very strong. Employers have job openings. They're increasing pay. That's part of the problem, Bill, because that means that the cycle of inflation that the Fed is trying to break, essentially they're trying to slow down the economy, is still not being broken the way they want to see it. So I know it sounds weird, but the Fed wants to see a weaker job market, which means lower salary increases for you and I in order to get this inflation thing under control.
Hey, Dan, really quick, we've been hearing a lot of analysts saying that we may avoid a recession. Others say that it's inevitable. What do you actually think on that?
Well, that's a great one. Listen, recessions are inevitable. You and I know that. We've been around for a little bit. They're a normal part of the business cycle. Will we have one this year? I suspect if we do, it'll be mild. We're not going to see something like we saw in 2008, 2009, Bill. I don't think we're going to go back to there. But a mild recession may very well be in the cards this year as the Fed tries purposely to slow down the economy.
And so more interest rate hikes may be coming as a result of that. Dan Roccato,
For sure.
Always a pleasure, sir. We appreciate it. Have a great weekend.
All right, Bill, take care.